Hello, everybody. My name's True Demon, and I'm the Devil Stockbroker. We're going to be reviewing the market, which performed rather mixed, although tech sector was, on the whole, rather green. The tech sector for Microsoft, Google, Meta, ACN, Salesforce, and Adobe all recovered somewhat of their losses from the previous trading week, which, as you may well know, saw huge selling off after the FOMC meeting completed. Besides the tech sector, a lot of the defensive stocks also performed extremely well. Energy, finance, commercial services, and health technology all green across the board. Producer manufacturing was also performing quite well. What this all translates to is essentially tech versus industrials, or risk on versus risk off sectors. And I've placed this chart here, which shows you together a ratio chart of the Qs over the Dow Jones Industrial Average, the Qs chart by itself, the Dow Jones by itself, and the SPY to see how it compares. What I would like to call to your attention is that currently the Qs, which is mostly made up of tech and risk-on sector index and stocks, is drastically underperforming the Dow Jones shown here. If you look at the trend lines, you'll notice that the Dow Jones has been bouncing off of this continuously rising trend line, whereas the Qs gave up this rise sometime in October. And since hitting a high at around about 285, the Qs haven't ever tested that high again, whereas the Dow Jones had already passed this area back at around 321. So since that point, Dow Jones has risen to new highs up 1%, and then a few weeks later up 3 and 4%, and has retested these highs multiple times. Now, there was some recent selling going on across all the sectors, and we saw basically all of the market drop after the FOMC rug pull. But it's notable that the Qs have still been underperforming the Dow Jones continuously. And we can see this latest move that was reflected by all sectors, as well as specifically the SPY was the one that we were watching the closest. While Dow Jones is already recovering back to a previous high, the Qs haven't come nearly as close. What we would expect to see is for the risk-on sector to have already recovered to this level, but it hasn't. Instead, it's still barely breaking previous resistance. What does this mean for the stock market? Well, it generally indicates that the market altogether is extremely risk-off. All investors are pouring their money into safe haven stocks. And this is very bad for the tech sector, and especially the SPY, because the SPY itself depends mostly on tech-heavy index, it's a very tech-heavy index is what I mean to say. Stock tickers like Apple, Microsoft, Tesla, all make up the largest tickers on the SPY. And what we can also draw from this is that overall the tech sector is not where investors want to be right now. So there's two strategies that I'm going to discuss with you very briefly in order to indicate what direction these stocks may be taking in the near term. First, we're going to tackle the SPY because it is the popular one right now. The SPY broke an ascending wedge here that was part of a much larger head and shoulders formation that I have drawn out over the last week. This entire head and shoulders has taken more than 7 months to form. It started back in late May and has just recently completed the peak of the right shoulder at the 1st of November. And we have been trending down. Now, we've gotten a little bit of a bounce here, forming what I would consider to be a bear flag on the 30-minute chart. And this is important because right now, a lot of bulls are considering that we are in a we're in a market that is deciding on a bounce point. Generally speaking, everybody is expecting the entire market to rally for a seasonal rally. And up until recently, I also was in that same camp. However, seeing the divergence between Dow Jones Industrial Average and the SPY and Qs tells me that where money is going is not going to lead the SPY on this grand rally quite like everybody expects it to. So we're all about finding where to put money that is going to be the safest and in what direction will make us the most returns. So while I would say that the SPY could rally, I would caution against going long in the SPY right now because all of the technicals are still in extremely bearish territory. For instance, this price cloud oscillator, which we've been using to rather good effect, has shown that we have topped the market multiple times every time that this has touched outside of a price cloud. And we've recently had a cross outside of this price cloud on the 30-minute chart. On the 1-hour chart, we have also touched outside of the price cloud, but we are still waiting on a crossover. I generally consider, and this is just my trading strategy, that the 1-hour time frame is much more consistent. You'll notice that out of all of these crossovers, in the last 6 crossovers that occurred outside of this price zone, we have had 1, 2, 3, 4, and 5 that have hit the top of their market. This one here is also touched outside but did not cross down outside of its price cloud. So out of all of these signals, we've had 100% accuracy just in the last 30 days of trading, which is that's a phenomenal ratio. It doesn't work all the time over the long term, but generally this indicator will get you good trades on long-term swings. Now, right now, as I see the SPY retesting previous areas of support that has now become resistance, I see the SPY struggling at 380 once again. And we've had this touch with a evening star candle as our ending 1-hour candle on this chart. It was exactly at this point that I decided, okay, I'm going to go short on the SPY again. I was already short on the SPY after this tweezer top candle from Friday, and I decided to average down my short positions here, adding to my position. And the reason why is because we've had 2 touches on this bear flag. I was anticipating this head and shoulders to play out more directly, but I did give room for the possibility that instead of going straight down, that we would instead come down halfway down the shoulder, bounce, and then resume falling. And that would be consistent with Elliott waves, such as what we've seen here. So, for the SPY, what I consider this to be is confirmation of the drop to the downside, because we have established resistance here that we broke through here, and now we have had our first retest of it here. So it's quite natural for this retracement move to occur. And if you do use Fibonacci's, you'll notice that this sits just below the 50% retracement level. After a big impulse wave move, it's very common to see a 50% retracement move in order to confirm that move to whatever the original direction was. So since we started moving into the downside, we hit a low, and we have since retraced to the 50. Now, once we see rejection off of this level, we expect to continue selling back to the original level on the fib and to continue even further for the entire length of the previous impulse wave move over time. Another confluence that I was looking at also is if you go to the 2-hour chart, you'll notice that is right here, this evening star candle, which is just printed but not yet confirmed, actually touched exactly on the 200 period moving average. This is an exponential moving average, and it coincides with a touch outside of the price cloud on our oscillator for the 2-hour chart. And if you'll notice, every time that we have hit a peak in the 2-hour chart and a cross down, we also had a big bearish move that followed in the SPY. So this indicator still holds true to its performance. And as a matter of fact, if you had actually shorted on this cross down, you would have been quite close to the top here. However, I like to wait for bearish divergence, so I actually trade these touches on the outside of the price cloud on the first bearish divergence I see on the chart. And I actually got this confirmation where I entered my first short position back in the 2 weeks prior at the end of October. So for those that are currently looking at this entire formation and believing that, hey, this looks like we're hitting a bottom and the stock market's going to start trending back up, I'm really hesitant to accept that argument, just because overall the stock market has been showing signs of hesitating. The news coming out of the Fed and the hawkish nature of their speeches tells me that the market, or rather the Fed, is not satisfied with the movement in the market, and they still want to see jobless claims rising as inflation is falling. They haven't gotten that confirmation yet, and even Jerome Powell himself said at the last speech that he made following FOMC that we need to see multiple consecutive reports of inflation coming down via CPI and PCE, coinciding with a rise in unemployment consistent with our expectations. And since they're not seeing that, there's no way that they can expect a 50 basis point hike or a pause in December. So the market right now is floundering and fighting for air, but I anticipate that as time goes on, and especially with CPI coming out this Thursday, that we are very likely to see an abrupt sell-off going into the CPI report this Thursday. Keep in mind, CPI report releases at 1 hour before the bell, 8:30 a.m. Eastern Standard Time. Looking at the Qs, we see a very similar momentum in the market with huge moves to the downside and a big bear flag. I would actually argue it is a bear pennant, with resistance being met just below the 50-period EMA on the 1 hour chart. On the daily chart, we're trading quite far away from all of our moving averages, so one might be led to assume that we're due for a bounce here, for a little bit of a wave to the upside. However, seeing that the Qs has been underperforming industrials as well as defensive sector stocks, I'm inclined to believe that smart money is getting out of the risk-on sector and preparing for late-stage wave of the crash. Because of that, I don't expect the Qs to perform anymore, and what we'll end up seeing instead is these moving averages continuously getting farther and farther from each other over time as the market continues to sell off long distance. For this reason, I think the ideal short position is actually trading for calls on the SQs, or just simply going short on the Qs if you prefer. But for me, SQs is a little bit cheaper. It gives you a little bit of leverage with 3 times leverage betting against it. And by taking a call position on SQs, keep in mind this is an inverted scale. So when the Qs goes down, SQs goes up in value. So if you were to go short on the Qs, you would want to bet bullishly on the SQs. So betting on calls for SQs or buying SQ here and then waiting for the Qs to fall. And if you note the pricing on SQs and the Qs, what you'll see is that if the Qs drop down to about 260, then that amounts to around $61 on the SQs. So compare those prices to each other from the left and right. You can see 61 on the SQs over on the left is about 260 on the Qs to the right. So you can actually bet on a call for SQs with a strike price of $61 for a month from now. It'll cost you a little bit, but if that ends up going in the money earlier, sooner rather than later, then you can actually see the Qs dropping to 250. That call will end up more than $5 in the money, and you can take a $500 profit for each call contract that you purchase this week. Assuming, of course, that we do get the move that we're looking for. Price targets for this level, I'm actually looking for the Qs to sell off as far down as 420 between now and the rest of the year. If we do not actually complete this double bottom bounce and see the market recover here, if we collapse back down past 260, then I do anticipate the Qs falling all the way back to 240. My premise for this is that this is where previous support sat at. We haven't been trading in a significant area of that provides good support for the Qs since around the COVID pandemic. So considering that this is our last leg of support where we've had a consistent area of trading, once the Qs breaks this level, there's a huge air gap in this area for it to fall all the way down to easily to 240, but could also see a big drop all the way down to 200 if things got truly, truly bad. I wouldn't bank on this happening in the near term. I would end up playing this to well into next year, kind of betting on continuous bearishness across the risk-on tech sector for the duration of 2023, at least until the summer. But if you're betting on the near term, then I think that 260 is a good price target. Dow Jones is looking quite good, actually. As a matter of fact, if you take this trade down to from the bottom of its chart all the way to the top here, you can see that it's formed a bit of a broadening wedge or a broadening bull flag. You could argue that this bull flag is broken out. However, the problem that I have is that the Dow Jones is now trading at the top of a megaphone pattern where it has sold off every single time that it's reached this point in the past. So because of that, I'm very, very hesitant to bet bullishly on the market here. Dow Jones, just because the industrial sector is outperforming the Qs doesn't mean that it's going to perform well continuously for the duration of the season. What we might end up seeing is the retail sector ahead of the Christmas sales season surge. So stocks like Walmart, Amazon, Target, so on and so forth, are likely to see a boost in sales volume, and that would take away from other stocks on the Dow Jones and focus that cash flow into the retail sector. So because of that, there may be some selling off in the broader market for the Dow Jones as institutions target the retail sector in order to take advantage of that sales volume increase, that seasonal increase in volume we see just about every year. As well, this kind of goes hand in hand with an inflation hedge, which everybody has on their minds because the cost of energy, gasoline, and other petroleum products is continuously rising, while we've seen some retail sales goods and consumer staple goods starting to finally come down in price just a little bit. So there is a possibility that we end up seeing Dow Jones top here and form a double top formation, which would see it selling back off to the retest its bottom here at 28,750. Also, do take note that we did have a touch outside of the price cloud with a bearish crossover in this area, and we are seeing the possibility of bearish divergence. However, we haven't gotten a higher high on the Dow Jones, so the price has made a lower high, and the RSI is also making a lower high. So this does not indicate bearish divergence yet, but it could still end up performing bearishly if the Dow Jones doesn't get one final push to the top of the market here. If we do see that push to the top of the market and it retests this area somewhere between 33,000 and 33,500, then that would most likely result in bearish divergence on the RSI, coinciding with a higher high in the price. And that is where I would look to enter a short position on the industrials. That would be an ideal entry for that play. We're going to check up on the SPY versus HYG ratio chart one more time so that everybody gets a chance to look at this before we go into Tuesday. HYG, which is the high yield grade bonds, serves as a barometer for what the smart money is thinking and what they are doing, believing that the market is going to go up or down. We can see that HYG has been struggling a lot with the SPY pushing upward and forming this ascending wedge pattern. We see that HYG is instead forming a bear pennant following this big drop to the downside. So this bear pennant is quite telling that HYG is just not getting the volume or the interest that SPY was getting before. And interestingly enough, the SPY and HYG ratio chart is actually forming a classic double top pattern with a 50% retracement, touch, and rejection. If we see HYG moving to the downside ahead of the SPY's next push, then this ratio chart will drop off very, very quickly, and what we'll end up seeing is the SPY selling off very shortly thereafter. Just pointing out again that sell-offs in HYG or patterns where the ratio chart is descending while the SPY is reaching a top or creating a topping pattern of any kind has always consistently predicted a sell-off in the stock market. Here, for example, HYG sold off massively ahead of the SPY. The SPY did gap down slightly, but you'll notice that the market underperformed for the remainder of the week, and the SPY actually took a very heavy hit from 390 all the way down to 369. Further to this point, the price clouds oscillator has consistently marked tops in the market that were confirmed by HYG and the SPY diverging from each other. And when HYG moved ahead of the SPY always followed and made a big sell-off following this signal. One more to wrap up with. We currently have the VIX on the chart, and the VIX, as you'll notice, has had several bottoming formations in its past that look very similar to the one that we have right now. The most recent one being this move right here. So this bottom formation came after a further bottom in the stock market, or it came after a bottom in the VIX, which coincided with a top in the stock market. And this bottom, which followed, was confirmed by this diamond top here in the SPY, and then after the VIX took off, SPY went down. And we've had another formation right here that was very similar to this one, where we had a whole lot of volatility and jumping around, but very much price bound between a very tight range on the VIX. This also indicated a big top in the market, and then we saw a huge sell-off in the SPY for the following several months. Now that we are currently trading in this formation, where we have got essentially a giant ascending wedge in the SPY, the VIX is again consolidating in this area in a very tight range. What I expect to see is for the VIX to eventually break out above this 200 period daily moving average, and then we will quickly see the SPY sell off. Considering that we've got multiple bearish indicators and patterns all developing at the same time while the VIX is throwing a big sell signal for the market, I'm really hesitant, like really, really hesitant to go long at any point here on the SPY. There's just too many indicators that are telling me to go the opposite direction. For the wrap up, we're going to look at the defensive sector stocks that were called out before. As you can see, Boeing did very well today. We had a big gap up, and it continued moving to the upside, forming a what I would consider to be a bullish pennant. Looks a bit like a symmetrical triangle to me, and this move to the upside is quite indicative of some good strength in Boeing. So upon a breakout, I would anticipate Boeing making the full length of this move yet again. So waiting on a breakout signal from Boeing tomorrow, we can take an entry and look to trade it in excess of 170 on the call for a call strike. So if you're looking for a quick trade on Boeing or any other defensive sector stock, this one is already on the move. But please keep in mind that we do see a little bit of bearishness on the PPO and the RSI. So keep your stop losses tight and don't trade any further below than the bottom of this wedge. If it ends up breaking down, then you'll want to get out of that quickly. RTX is still within its trading structure, which does seem to have confirmed a double bottom pattern here on this trade from this momentum that it made between Thursday and Friday, November 3rd and 4th. And now it's consolidating into this little bull flag right here. So it may require one more retrace and then a third touch of the flag before it's able to break out. But it could also just simply gap up in the morning. So we'll see what it does. If at any point we see Boeing close a 1 hour candle above this 96.50 area, then I would take that as a buy signal and make the trade. For this particular trade, I would keep my risk to reward ratio rather tight. So I would want to be trading with something a bit like this. Want to try to keep it tight, but still at a decent risk to reward ratio that makes it worth your while. For me, 2 to 1 is decent. Ideally, I go for 3 to 1, but this is a good setup. And right now, defensive stocks are pushing. Everybody is concerned about conflict with Ukraine and Russia, so defensive sector stocks like Raytheon Technologies are the hot topic right now. And this is currently what the market is bidding up. And then finally, wrapping up with the energy sector, which you can see is still completely tearing faces off. The channel that it's been trading in has been very, very consistent, and it shows no signs of stopping or even slowing down. So this is a pretty good indicator that inflation is still here to stay. Keep in mind that XLRE is at or XLE, excuse me, is sitting right at resistance where it got knocked down pretty harshly. So if you do end up seeing a breakdown outside of this channel, then this could be a good short opportunity. So at any point you see a drop from this level, then you could most likely take a trade to the downside for around, I would say 80 is actually a more attainable target. Don't want to go too far away, and that would set you up for a 3 to 1 risk to reward ratio trade. If, however, this keeps going, then honestly, there's no way to know when it will stop. Inflation is still on a big concern for everybody, and as long as the energy sector is outperforming the SPY, then we can take this as a sign that inflation isn't slowing at all. That's going to be it for this video. Thank you guys so much for watching, and I will see you next time. But until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.